A new report from Equifax Canada finds consumer debt continues to rise, even as mortgage volumes decline. According to the Market Pulse Consumer Credit Trends and Insights report, an increase in borrowers helped push total consumer debt to $2.36 trillion in the third quarter, for a 7.3% rise from last year. Rebecca Oakes, Equifax Canada's head of advanced analytics, says the rising debt stems from a combination of growth from immigration and pent-up spending. This, as well as increased borrowing as consumers feel the strain of higher living costs. Credit card spending in the quarter was up 17.3% from last year, at an all-time high for the time period. Average spending put on credit cards was almost $2,447. Now, this is a 21.8% jump from the third quarter of 2019. Joining us now to give us the latest insights from this report is Ms. Rebecca Oakes herself. Ms. Oakes, welcome to Forum Daily.
Thank you for having me.
So what do Canadians need to take away from the latest Market Pulse report?
I think what the report is really showing is that we are in a challenging economic period right now. We've seen inflation levels being high for some time, and we're starting to see the impact of that in terms of how consumers are spending and potentially what's happening to their debt levels as they start to put some of that spending on credit. So I think the takeaway really is it's a challenging period for a lot of people.
A challenging period indeed, Ms. Oakes. Now, you mentioned that contributing factors to the growth in consumer debt includes increased borrowing amid this rising cost of living in Canada. So, was this to be expected amid inflation and interest rate hikes?
So we certainly do see this when we have periods of inflation, and indeed linked to some of that is going to be the impact of interest rates as well. So as cost of living goes up, there will be some consumers in this period who are able to weather that storm. They have savings perhaps, and they can keep on managing without putting additional spending on credit. But for others, it's a trickier period right now, and they are potentially needing to rely on credit for their day-to-day living costs. And so I guess in that kind of period of high inflation, it is kind of expected that we will see some growth in consumer debt.
And do you expect this upward trend to continue considering the uncertain times that we're in right now?
I think unfortunately the simple answer to that is going to be yes. I mean, when we go back to what happened during the pandemic, we actually saw many consumers pulling back on their credit usage, in particular on things like credit card spend. We saw drops to 15-20% in terms of balances. Now, some of that was really helped by some of the government programs that were put in place. There were some consumers who actually found themselves in a slightly better financial position because of some of that government support. So overall consumer debt levels did drop during that period. So we do expect them to return to normal. Unfortunately, I think what we're seeing in our latest report is that we have now hit that level. We are back to pre-pandemic levels when we look at non-mortgage debt. And right now there is no sign that's going to slow down just yet.
Now, meanwhile, we know economists are predicting an economic slowdown in early 2023. Some are even talking about the possibility of a moderate recession. So how do you expect consumer debt to be impacted by this?
Well, one of the good things right now is that Canada has a very good economy in terms of jobs. We're seeing unemployment has been at real lows, and we're seeing job vacancies are up. So, while you still have that strong position in the job market, that does help to kind of protect a little bit from a recession. Now, if we do go into a moderate recession, you might start to see people losing some of those jobs. You might see businesses start to struggle a little bit. And obviously that does have a knock-on effect in terms of how consumers can make their payments on any debt they have accumulated, and potentially some of them might start missing payments.
And what kind of supports or resources are currently available to help Canadians manage their debt right now?
I mean, there are lots of charity organizations out there who you can go to who can help you set up things like budgeting plans, just looking at your day-to-day spending and seeing how potentially you can make changes to your credit usage or your spending to really help you. So I highly recommend, reaching out to some of those organizations should you feel that, potentially the outlook for your own individual finances might be a little bit uncertain.
Now, I want to build on that last question. What kind of advice would you give our viewers when it comes to debt, their financial well-being, and preparing for the year ahead?
There's a couple of things I would say right now. First of all, we are entering the holiday period, and it is so tempting for us to all want to kind of go out and have a really great festive or holiday event, just be a bit mindful of your spending, because it is easy to get carried away. And then come January, when you get your credit card bill, that can be a bit of a challenge. The second thing I would say is, if you are a homeowner right now, we know high interest rates is impacting consumers immediately if you have a variable rate mortgage, because obviously that can change some of your payments. But actually, even if you're on a fixed term mortgage right now, maybe your fixed term doesn't end for 12, 18 months. Just have a think about what might happen if your payments do go up at that period, and start planning for it in advance. Interest rates are not going to go down anytime soon.